Hey guys, this is Simon with Trade and Perform Coaching, coming to you live actually from our new offices. And want to do kind of a little bit of trade review from Friday. Someone asked me a very good trade question on Friday and get everyone ready for the trading week. And so we're going to touch on primarily on ES and NQ and then touch a little bit on the 30-year note and on CL. And then we're just going to uh, roll into the week. So a couple of things before we get started. Number one, let's do the disclaimer really quick. It's a legal notice. Basically what this says is that this is for educational purposes only. This is not a recommendation to buy or sell any particular financial instrument. Futures trading in particular, which is what I do, has large potential rewards, but also large potential risks. Be aware of the risks. Be willing to accept them. Don't trade with money you can't afford to lose. The website's neither a solicitation nor an offer to buy or sell equities, futures, or options. Past performance is not indicative of future results. No representation is being made that any account will or is likely to achieve the profits or losses similar to those discussed on the channel. Consult your registered financial advisor and your risk trading plan before ever investing any financial instrument. Okay, so let's get rid of that and friends kind of discuss what happened Friday. Friday was an interesting day, okay, and so this as a coach, as a trading coach, was what I'm more concerned about than anything else here. When we talk about coaching and making trading decisions, so non-farm payrolls has the same potential risks that, say, when you have future contract rollover or when you have the Fed come out and make interest rate decisions, right? And we have some pretty good examples of what that can look like, and I'm going to show that in just a second. However, what you're balancing as a retail day trader, right, is the decision of, can you figure out the risk ahead of time, or are you willing to accept the risk ahead of time that there might be a very difficult opening? Okay, so when we don't have OTF involved, what you get is a very nice kind of push back and forth, kind of, even if it's going somewhere, you just kind of get this lackadaisical back and forth type of price action, right? When you have OTF involved, and particularly on the downside, you get these big downside pushes. And we have some pretty good examples of that occurred recently. And I think it's important that people know and see what those look like. So I'm going to show them really quickly here. They generally involve a high amount of volatility, and the markets really get roiled and run people over badly. So the best example of that, when OTF steps in, we had just a couple of days ago. And that was right here, right? Basically the first day of July, where we gapped up, we got open drive lower, OTF other time frame stepped in. And some of the characteristics of other time frame is relentless buying or selling, right? Lack of counter rotation, no consolidation, and an inability, and this is a big measure, right? An inability to get back at any meaningful point to a 50-60 retrace, right? And it's also, so that measure is also pretty important, right? Because you'll notice early in the morning on that first date in July, right? You'll notice pretty early, we did get back to the 50 retrace, but see how we can't get above, that retrace all the way through. Now, that's interesting because if you look at the next day where it appeared like we had a similar setup, it gaps up, it appears to have a delay, what I would call a delayed open drive lower, but you know that's busted when we trade and close behind the 62 retrace. So that's a little secret, guys, that y'all can use to figure out whether we are in true open drive lower or not in an open drive lower. So the one that I'm most concerned about, and I want to show y'all here, and it happened a little while ago, and it was this date. Okay, so this is one example where we gapped down. We had open drive lower on the 29th, right? And then we also had a date where we had extreme volatility. And I'm going to show what date that was, because that was the date we had that big rollover, and I think it's right here. Okay, so this was the, I believe it was the 9th, and we had quad witching. Okay, so the reason why I'm bringing this up is because you have several things that occur that can be difficult. Quad witching, right? You have quad witching, options, any options expiration, Fed day, non-farm payroll, like we had on Friday, right? And then you have any interest rate decision that the Fed may make, right? And in those situations, the risk is that you get crazy outsized moves. And if you remember, if you go back and look on the 9th, this is exactly what I'm talking about, where everything opened up, right? If you look at the beginning of the day, and so go and look at how radically this changed, right? If you go and look at this day, how it opened up, it really seemed pretty benign, right? And as a matter of fact, it looked like we were going to try and break out to the upside, and then it just completely fell apart, right? This is OTF stepping in. So now that we've made the distinction, this is not OTF, this is OTF. So now let's go back to the date when we came in on Friday, right? And hopefully I'm making my point clearly and not overstating the difficulty, okay? You know that you had non-farm payrolls. If you go back and look at the history of non-farm payrolls beyond the past year, you can get a very high amount of volatility and very big whipsaws, right? So what you have to decide on those days, Fed days, OTF, same thing with oil inventories, right? Is whether the only decision you have to make is if you trade, are you willing to take the loss on those particular dates? Yes or no? If the answer is no, right, you have an easy out. You can go, and here's the key measure, right? If you had I'm getting ahead of myself, and I can tell when I can't convey an idea very clearly that I need a pause. So we're going to take a pause, and we're going to do just that. The white zones are the focus of my trading, right? And if you'll notice on NQ here and NES, what I would normally expect to happen is that the first time we touch a white zone, long or short, is that we get a counter rotation on that first touch, okay? The pain of the situation is I know that we can have OTF step in because it's non-farm payrolls, and that if we can get to this white zone, and on those particular days, the odds of this white zone failing do increase, okay? And so for me, it comes down to a very basic decision. If I skip or step past the first hour of trading, right, I can generally avoid where the majority of the pain occurs, right? And I tend not to get run over. But there is another decision I can make. I can choose to take the white zone, right, the first touch of the white zone, which, by the way, in both markets, both long from the open, we basically opened on top. There was no opportunity here. There was not even a tick down on it. We opened right on top. But I could have taken the first short for almost 15 points on NQ. I could have taken the first touch of ES at 24.1750. And I believe, I'm not going to go and add it up, but I believe this gave me a rotation for 5 points, right? I chose, because it was non-farm payrolls, to simply step aside. I would have taken this trade on any day. So now to go to Randy's question. Randy's one of the members in the room, and he asked me, how could have we known that the market was going to drive up like this, particularly when you had key resistance right above? And I'm going to answer that question right now. And I'm going to go through a checklist item, which which anyone can use to kind of go through and make some determinations. So first of all, we had two events that occurred. We had gap ups in both NQ and ES. And both markets gapped up, and both markets held both NQ didn't even bother with a half gap, and ES held the half gap. Neither one filled the gap. So that's number one indication that buyers are in control. I have a general rule of thumb. If we don't fill the gap in the first hour, there's a relatively low odds that that gap will get filled. Okay, so that's the first clue we had that buyers were generally in control. Next, and I'm going to step right through this step by step. Here's the swing low. We get a higher low. We do get an equal high right here, but we get a higher low. So we know that last swing low has to get broken in order to have any indication that we're even coming in and filling the gap, right? That still wouldn't even be really bearish. It'd just be an indication that we're going to fill the gap, but it's a very strong sign that buyers are in control. We have a higher low in NQ as well. Additionally, we've rejected one time off the white zone. First time off the white zone, we reject once. We reject twice, right? You'll notice that we're getting higher lows and higher highs all the way through here and forming a wedge right underneath the white zone, which is a good indication, right, that energy is building, right? So the zones did their job, right? They contained the upside move, okay? They gave tradable rotations down, which on this particular Friday I chose not to trade, even though the zones were definitely very valid, right? And then finally, the last piece would have been that if once you saw this first rejection, second rejection, and you saw the third higher low, and what you'll also notice in here is that we could not get past the 50 retrace of this bar right here. That was the indication that we were really going to bust through and drive higher. And the NYSE tick, which I don't have on here, was all very strong. So, and then you'll notice one other piece here that's very, very interesting. Right, let me erase this real quick. Okay, so on NQ, notice that when we got to the top of the white zone, see how we didn't reject? Look how long we consolidated. 5, 10, 15, 20, 25, 30, 35, 40. Now, think about what's going on there, right? For a second, guys. Part of being victorious in trading, part of putting capital to work in your account, is recognizing what your opponents are doing. We discuss this every single day in the room. What is the person on the other side of our trade? What are they thinking? What are they doing? What are they trying to get accomplished, right? So think about it. If you have someone short, in order to get this momentum to stop at the back of the white zone, right, what you would have wanted to see is it push in and then immediately have the responsive sellers be so overwhelmingly strong that they pushed straight down and out of the white zone and pushed lower. That didn't happen. What happened instead was we got to the back of the white zone and it consolidated sideways for 5, 10, 15, 20, 25, 30, 35, 40. These guys that were shorting up here or selling up here, their hands were forced in to come in and yet another short squeeze. Additionally, look at ES. ES actually got up and above the white zone and then consolidated above again, almost a full 40 minutes here before continuing higher, right? And then finally, the last element that told you not to fight the shorts, or not to fight for the shorts or not to fight the longs. Look at the lack. Okay, so look early in the morning, right? See how big the counter rotation bars are here? These bars, I'm going to spread this out so you can see. These down bars, this is essentially from the time we hit the peak, 24.17 down to 24.15. 24.16 down to 24.14. These bars are two points in counter rotation, right? So next, notice it's all green bars, and now look how small the counter rotation bars are. These all of a sudden get down to 1 point or less, right? What you want is to be on the side where the movement is going easier, right? So all that's happened here is that the market has run out of energy. And in all likelihood, in overnight, we're going to push up towards this 24.27. And my guess is into the European session, we'll push to this 24.27 because it's the logical next location up. Same thing with NQ. This 56.91 to 57.01 is the logical location up, right? So at any rate, Randy, I hope that answers your question. The clues there again, just to reiterate one more time, because it's so important that you recognize it. Gap up in both NQ and ES. Lack of attempt to get half gap or gap fill, right? And then there's a couple other things in there that we go on in the room. Strong NYSE tick, right? Higher lows, right? And initial rejection, but really a wedge forming here as we were pushing up. I'm not sure there was really a good place to get long for the way I trade, since my primary trade, what I'm looking for is a push down, and then to get long, this was a non-traditional open drive higher, right? It was really delayed. We gapped, and because there was significant resistance above in both of these markets, it really didn't give me an option to get long, and you can see how long it took the buyers to overcome resistance in this area. So Randy, for me, there was just no great place to get long, and had I traded, okay, had I chosen to take the risk of trading on non-farm payrolls, I can tell you this is exactly where I would have shorted right out of the white zone. So hopefully that made sense, and that's kind of how you tell when buyers are in control and you have a major piece of resistance above. This is, I would make notes because this is a really good picture of what it looks like when traders have to really sit there and hammer on a piece of resistance before they can finally break through And what they have to do is build enough energy and collect enough shorts to force them to squeeze in and drive right through it. And what you'll notice is the price action was identical in both markets, right? Build, 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 pop. Build, 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 pop. So now let's go take a look at CL and NQ. And I'm going to use my TPO charts, or we can use the volume profile charts actually. They work just the same for our purposes, and give a quick review of the market going into the week, right? So what we have, let's start off with ES, right? And ES, let's get rid of all. Okay, what you're going to notice is, first of all, if we can hold, right, the general bottom of the trading range, right, minus a few closes underneath, right? See all these, for those of you that are new, see all these little arrows right here? We have all these little arrows. See how all these arrows are closing above 24.19? Every one of them are closing above 24.19. We only have one that's closed below. Every other time we've pushed below 24.19, we have managed to close above. Okay, so before that line in the sand, before we move lower, was really right here, right? It was 24.25, which you'll notice was resistance on Friday, right? The top end of resistance where we slowed down. So a couple things. If the market can manage to, first of all, close back above this 24.25 level, back where all these markets, all these days had closed in above, there's no reason to think we won't trade back to the very top of the range, maybe even to the extreme, to a new high, which is over here, right? But what this also tells me is that in the last couple of days, we've had a general downtrend. See this? And they really put the market under a pretty considerable amount of pressure, and it wasn't able to break. They really had a chance here when we closed at 24.10. They really had a chance had we come up and rejected on Monday out of this 24.19 and pushed back to 24.10. That would have really kind of given me the idea that we have a good chance of pushing in and testing towards that 23.90 to 23.80, which I would have loved, right? But instead, because of the close now, I know that I'm going to have to get below 24.19, right, and manage to get the market to close underneath and then not let it get back above 24.19. Right now, that's the measure for a move lower. Otherwise, as long as we're holding and trading above 24.19, my assumption is going to be that we're going to come back up and try to test this 36 to 44 level again and possibly retest the highs, right? The other thing you're going to note is, see how much time we've spent in this area? It generally makes, when we spend so much time, two things. The middle of that area gets difficult to trade in, but it also gets choppy in here, right? And if you think about the time of year we're heading into, that makes sense. If you saw how slow and grindy Friday afternoon was, right? Expect to see the same kind of slow grind Monday afternoon. You're really going to want to try to get it done early in the morning or very late in the day, one of the two, because otherwise people are going to get lackadaisical. There's not a lot to do in summertime. This is knowing your market cycle and where you're at, and we're just heading into the dog days of July. And remember, even during the best of markets, Monday and Friday are the narrowest ranges going into the week, right? So again, the trade plan for the week in a broader sense, holding above 24.20, I would expect a slow grind and attempt back towards 24.36 to 24.44. Of course, the zones have already been posted for tomorrow, and the key focus will be rejection out of the white zone. But in general, I expect the market to eventually work its way up towards 36 to 44 as long as we hold that 19 level on a closing basis. Okay, let's go look at NQ really quick. Okay, for NQ, a little bit different picture, but notice something here really interesting. Let me erase all this, except this trend line. Okay, see going back here, see this trend line that it held? It started all the way back in late December 2016, right? We held all the way up, and then notice we broke and finally closed underneath that trend line. The reason why I'm mentioning this, again, this is from a coaching perspective. I just spoke about how in ES, 24.19, 24.20 is now very important. Well, this trend line had become pretty important psychologically to the market, And notice once we closed underneath it, prior it served as support. Prior support, this is kind of has now become a moving resistance line up, and it finally rolled over. But look at the bigger picture on NQ, right? You've seen a lot of bearish talk underneath the 50-day, so on and so forth, and it's correcting, right? So imagine yourself being an investor, right? This is March, right? Let's say you're an investor and you went all in March, because remember, what do you need for a market to fall apart? Day traders are by definition the weakest traders. It doesn't matter how great a day trader you are. You're a day trader, which means you're going to be liquid at the end of the night. You're going to be reinvesting in the following day, and you're trying to pull money out. That makes you the weakest trader versus an investor who said, hey, I'm buying the NASDAQ right here, and the only way to scare these people out of their positions, okay, so maybe they have some money management tools and they're going to scale as profits go up, but generally these people and everyone below them, right, this is only going back to March, right, these people and all those people underneath them are not scared of what's going on. I want to say that again. They're not scared of what's going on with a down move in NQ. If you look, this is the May lows right here. And we have failed at this point to be able to trade below. What would you'd want to see is just like over here where we finally broke this uptrend. I'm saying this really slowly so everyone will understand it. Again, this is primarily for the benefit of the members in the room, right? So I want everyone to understand and be really clear so they understand what they're dealing with, right? Understand, in order to make the market go down, we had to break this trend line. Once we did, see how we came back up, rejected down, came back up, rejected down, right? So realize what's going to have to happen in order for us to break lower. Are we setting lower lows and lower highs? Well, we are since the beginning of June, right? But we still haven't broken the May swing low. Even if we broke the May swing low, right, you would get push underneath, and just like you had over here, you'd want to see a backside test for a short. Backside test for a short, push lower. The flip side of that is if we push underneath and we don't make a significant push underneath, let's say we only push by 20 points, right? And then it gets back on top, that backside test will come in and you can push back up, and this will end up very possibly becoming the bottom of your NQ trading range, and this could become that 5,800, the top of your trading range. And if you don't think we can have a 200-point trading range in NQ, you're very mistaken. We absolutely can. You get evidence of that, and let me show you the evidence of that so you can understand what's developing. You don't want to become bullish or bearish. You want to become balanced, right? So let's just go back a little while, right? Not too long ago, last year. Look at the range. Top of the range, roughly 4,900. Bottom of the range, 4,700. So market patterns repeat, right? People who got bearish down here on this double bottom got crunched all the way up for 200 points and then had to suffer the breakout, and they were all squeezed out and pushed back in, right? Markets trade both ways. Grasp it, get comfortable with it, understand markets rarely make vertical moves. They're normally breakdown, consolidation, breakout, consolidation moves. And what we've had in the past year has been a little bit unusual. I would expect range-bound trading, right, which is great. That puts us in the most profitable position. Let's go over to take a look at CL really quick. Okay, and the first thing that CL demonstrates to me, and I'm really glad because this is an excellent example to use as a parallel for NQ, right? And that is, look at this move a couple weeks ago. If you remember, this is the middle of June, and people were talking about how oil was going to zero, right? So understand how bearish people got down here. We'd come all the way down from 52 to 42. That's a 20% move to the downside. By definition, bear market, right? Anyone who shorted in here, we had a move from 42 almost to 48. It's 47, right? From 42 to 47 is 5 points, right? So a 10% move up off the lows, a little bit more than 10% off the lows, right? And this is why, as a day trader, right, you have to stay balanced in what you are looking for and understand that those markets are going to trade both ways. Don't get bearish in the hole. Don't get bullish, and make sure you have a process surrounding it. So right now, what you'll see here that's key is that all we've done so far is we've made a approximately 50 retrace off the last swing high. Bigger picture, we still have quite a bit of ways to go before we get back to the 50 retrace based on the new swing low. We are bigger picture making new lower lows and lower highs, and we have failed to get back to the bigger picture 50 retrace, which is right now sitting at 49.35 and 51 for the 62 retrace, right? Sellers, you can argue, are in overall control. However, right, it's a two-sided market, and I would expect that two-sidedness to continue, right? And obviously, the most obvious target is we're really not bearish. I would expect balance, just like we've gotten every other time we've gone into these ranges, unless we can get below and hold below the last swing low, which is at approximately 42. Okay, so CL, I'm looking for two-sided trade in CL. I'm not bearish there or bullish either. It's obviously in a bigger picture downtrend, but from a day trading perspective, I would expect, again, two-sided trading, right? And then finally, let's go over, and I don't have this chart up, so I'm going to bring it up, and that's the bond. And it should come up here in just a second. Of course, watch TradeStation be just as slow as daylights on this one. There we go. It wasn't so slow as daylights. And what you'll see for the week is that, first of all, bonds aren't in bearish territory in my mind until we get below 149. Okay, and it has quite a ways to go. If you'll notice, this is swing low, right? Most recent swing low. And what you'll see here is when we pushed up, pushed over, and we came right to the 50 retrace, right? So now we've come from this swing low, pushed up, and this has now become a little worrisome because we're consolidating underneath the 62 retrace. And I want to give an important point. All that it has to do is get above and hold above 152 to attempt to make a push back up towards 157. However, when a market is trending, we'll tend not to get below or close below that that 62 retrace. But from the bigger picture, meaning this swing low to this swing high, right? I'd be willing to bet dollars to donuts when we get to this 50 retrace right here at 150.29 30 seconds, right? That which is right underneath 151. I'd be willing to bet dollars to donuts that we find responsive buyers for a push back up, just like we did right over here the first time we came back in. You'll see they try to do a little bit of shake and bake and kind of push them back, but they held. This was the original 50 retrace. So this is from here to here. This was the original 50 retrace. That 50 retrace is now shifted left to the right, right? And it's gone from here, and it is shifted right over here. My guess is when we get into this area, we will find a little bit of shake and bake and some responsive buyers, right? So in the room, we know where the white zones are, and we know where the responsive buyers are, and we know what type of price action both from, and the reason why is we're following a process. The focus is on the white zones because we know the white zones offer us our highest odds chance of finding responsive buyers and responsive sellers for a trade. The focus is to get our leverage off and leave our trailers for a run so that we can get closer to a one-to-one risk reward. And and then going back and tying all of this in. If you're going to trade on a day where there's non-farm payrolls, if you're going to trade on a day when there's oil inventories, if you're going to trade on a day when the Fed is speaking or the Fed chair is speaking, all you have to be willing to do is accept that if your stop gets hit, you can live with it. Most days, right, most trading days, you don't have to deal with the Fed. You don't have to deal with non-farm payrolls. You don't have to deal with futures contract rollover or quad witching. For me, that's pretty simple, right? If you want a lower level of stress in your trading, skip those days. But if you do become committed to trade those days, commit to it. Write it into your trade plan. Understand both the upside risk and the downside risk, right? And follow your process. I cannot state this strongly enough as a trading coach and as a trader to other traders who are struggling. If you don't have a process that you're following, and I have a process for my pre-market, I have a process for while I'm trading, and I have a process for after I'm trading. If you don't have all of those put together, right, when things start to go wrong, and inevitably they will start to go wrong, I hit the pause accidentally, I didn't mean to do that. If you don't have a process and things start to go wrong, right, we can't look at your trading and go, okay, let's see what happened, and go, oh, this is where you went off process. If you don't have your best setups listed out and prepped, we can't go, oh, this is your best, these are your best setups, go get paid off of that, right? There's no way to do that. So anyways, that's my 2 cents. I hope that helps, guys. My name is Simon. I'm a Trade and Perform Coaching. My goal, sincere goal, is to help traders move from struggling traders to consistently profitable traders. And there's process and there's steps to be put in place for that, but it can be done. Anyways, I'm out of here, guys. I'm going to go and do some meditation, get ready to enjoy the evening with my lovely family, and I will talk to you all in the morning. Have a great night.